The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and a warm welcome to all. I am Ridul and on behalf of Care Ratings, welcome you to our today's webinar on employment. Appreciate your time in joining us for this webinar. To take you further on this, may I introduce our speakers for today. We have with us Kavita Chacko, who is the Senior Economist at Care Ratings. Along with Kavita, we have Sushant Hede, who is Associate Economist at Care Ratings. The discussion is in form of a presentation which is visible on your screen. We'll be having a Q&A session as soon as the presentation ends. You can please start keying in the questions in the slot provided. May I request Kavita to begin the session?
Thank you, Mridul. Good afternoon, everybody. In our webinar today, we evaluate the employment scenario in the Indian corporate sector to see if the job creation here has kept pace with the country's economic growth. In this context, we have also looked into the sector-wise as well as the size-wise employment scenario. The employee costs have also been covered here. Before delving into the employment scenario, a key aspect of the nature of India's employment dynamics needs to be highlighted. The country is dominated by a large informal sector, working as self-employed and casual workers in sectors such as agriculture, construction, trade, restaurants, transport, storage and communication, among others. As per reports by the International Labour Organization, the informal economy accounts for 90% of the country's labour force. As such, it is difficult to have a grounded and comprehensive view on the country's labour markets and employment generation. We have thus focused on the employment scenario in the formal setup, that is, the corporate sector. While India has been one of the world's fastest growing economies, having witnessed a robust growth of 7.2% on an average in the previous 5 years and a growth of 7.7% in the first half of the current financial year, the growth in employment, that is of the formal sector, has been lower. Our analysis of employment growth in the corporate sector, which is based on employment data reported by Corporates India annual reports, shows that the corporate sector employment growth of 3.8% in FY18 has been much slower than the 6.7% economic growth achieved in the year. This is reflective of the proposition that higher economic growth is weakly translating into higher job creation. It is also seen that there has been a moderation in the overall employment growth in FY18 over the previous year. This decline in employment growth can be attributed to there being a larger number of companies which have seen lower or negative employment growth in FY18 over FY17 relative to the companies witnessing higher employment growth. We have seen that more than 50% of the companies have either witnessed a negative employment growth or unchanged growth in FY18. It is well acknowledged that in order to sustain the economic growth path, there should be a simultaneous and commensurate creation of meaningful, secure, and remunerative employment. Our findings on employment trend have been in line with the finding of other private surveys. It need be mentioned here that although there are various government surveys done to estimate employment and unemployment, such as the survey by the National Sample Survey Organization, Labour Bureau, Annual Survey of Industries, these data here come with a considerable lag of a number of years and thus do not throw light on the recent scenario. The CMI employment survey data shows that employment rate, which is a proportion of working age population that is employed, declined from 43.5% in January 2016 to 40.6% in March 2018. It has further declined to 39.9% in November 2018. Now we shall detail the basis of our analysis. Our analysis is based on the employment data reported by corporates in their annual reports. The source of our data has been the ACE Equity database. Although the database carries data on over 39,000 companies, as only 1,610 companies have reported the number of employees in their employment as of the end of the year for the time period under study, which is the 4-year period from FY15 to 18, we have based our study on these set of companies. It need be noted that it is not mandatory for all corporates in the formal sector to report the employee count in their annual report. These companies which we have analyzed accounted for nearly 60% of the net sales of companies in the database. As such, the findings from the study of this sample can be seen as being indicative of the overall corporate employment scenario. The overall corporate employment during FY15 to 18 shows that the total permanent employees rose from around 5.4 million in FY15 to around 6 million in FY18. That is a compound annual growth rate of 3.5%. In terms of absolute number of additions of permanent employees, FY18 saw a higher number of additions. However, in terms of growth rate, there has been a moderation in growth from that in FY17. As the overall growth rate in employment is not uniform across companies, we have classified the companies which have witnessed either positive or negative employment growth in FY18. The chart here shows the proportion of companies based on the different levels of growth. It has been seen that more than 50% of companies have either witnessed negative or unchanged year-on-year growth in employment in FY18. 28% of companies of the sample witnessed employment growth of up to 10%. 11% of companies saw their employee strength grow by 11%. And 10% of companies saw a growth of over 20% in employment. For the sector-wise and size-wise employment scenario, I request Sushant to take this webinar forward.
Thank you, Kavita ma'am. We now move to the sectoral analysis of employment. Prior to understanding the sector-wise growth in employment, we look at this chart which shows the sector-wise composition of total corporate employment in FY18. There are 7 key sectors which account for 65% of the total corporate employment. These sectors include banking, IT, textiles, healthcare, mining, automobile, and finance. Out of these, banks have the highest share of 20%, followed by IT at 18%. Sectors like textiles, healthcare, mining, automobile, and finance account for around 5% each. The other sectors, which make up 35% of the total corporate employment, include iron and steel, crude oil, capital goods, FMCG, infrastructure, chemicals, among others. When we break down the total employee count in FY18 into agro-based companies, manufacturing, and services, we observe that almost 50% of the total employees are in the services sector, while around 40% are in the manufacturing sector. Now we look at the employment growth in these key sectors. Barring banking sector, the other 6 sectors have witnessed a moderation in employment growth in FY18 over FY17. However, it is important to note that there was a double-digit employment growth of 15.6% in the finance sector in FY18 over 31.7% employment growth in FY17. The high growth in this sector can be attributed to a number of reasons like innovation in financial products and penetration into semi-urban and rural markets. In addition, there has also been a demand for skilled technology professionals in this sector as information and data security has become a critical issue. The IT sector has seen a moderation in employment growth during the preceding 3 years on account of development of improved technologies and software advancements like artificial intelligence, which has led to machines replacing low-skilled employees. Despite textile being a labor-intensive sector, the growth in employment has been stable with a moderation witnessed in FY18. The mining sector has witnessed a contraction in employment during the 3-year period FY16 to FY18. In case of automobiles, on account of a higher dependence on machinery in the manufacturing of automobiles and its components, we see that there has been a moderation in the employment growth in this sector. We now compare the sector-wise growth rate to the trend growth rate of employment. The trend growth rate at 3.8% in FY18 is the overall growth rate in corporate employment. We find that there are 8 sectors which have witnessed growth higher than the trend growth. Out of these 8 sectors, finance and retail sector has seen double-digit growth in FY18. In case of the retail sector, which has seen a growth of 13.1%, is on account of the rising middle class and increasing exports by Indian retail companies, which has led to higher demand for retail sales, translating into higher employment. We now look at the sectors which have seen positive but less than trend growth in employment. There are 12 sectors which mainly include electricals, aviation, textiles, automobiles, FMCG, power, among others. The power sector has seen an employment growth of only 0.4% in FY18. The power sector has moved from a conventional to a non-conventional sources of energy, which has made this sector less labor intensive, leading to a marginal growth in employment. There are 19 such sectors which have witnessed a contraction in the employment, and they mainly include telecom, education, capital goods, mining, iron and steel, among others. In case of the telecom sector, intense competition in this sector has led to consolidation, which has propelled telecom operators, infrastructure providers, tower companies, and associated retail units to optimize their staffing, leading to a contraction in employment. In case of the mining sector, a contraction of -3.7% seen in FY18 is mainly attributed to the weakness in the sector and contractual nature of employment. To see the association between sales growth and employment growth, we look at growth in net sales and growth in the number of people employed. The general conjecture is that higher growth in sales of corporates translates into higher employment growth. However, we see that high sales have not necessarily translated into higher employment. Retail is the one sector which has witnessed a growth of 10 to 15% in net sales and a commensurate growth in employment. Similarly, there are a number of sectors like education, telecom, hospitality, paper, jewelry, healthcare, IT, realty, and textile which have seen low sales and low employment growth. On the other hand, sectors like gas transmission, steel, mining, and trading have witnessed a robust sales growth, but the growth in employment in these sectors is negative. Now we move to a size-wise analysis in which we have used the net sales of the company as a proxy for the size of the company. Companies having net sales below rupees 500 crores have mostly witnessed contraction in employment. The twin structural reforms of demonetization and GST implementation, which have led to temporary disruptions in small and medium enterprises, affected the top line of these entities, consequently leading to a contraction in employment. It has been seen that job additions are taking place in large companies having net sales of rupees 1000 crores and above. Companies having net sales in the range between 5,000 to 10,000 crores have seen an employment growth of 2.3% in FY18 over a growth of 15.4% in FY17. We now move from employment count to employee cost to company. It is important to note here that the employee cost to company includes cost for all segments of employees, including the managerial compensation. The growth in employee cost to company has moderated to 8.3% in FY18 over a growth of 9.2% in FY17. The growth in employment cost on an aggregate basis in all the 3 years remains above the average inflation at 4.7% witnessed during FY15 to FY18. A sector-wise analysis of the employee cost for key sectors shows that sectors like banking, steel, and healthcare have witnessed higher growth in employee cost to company in FY18 over FY17. Finance is the key sector which has witnessed double-digit growth in employee cost during FY17 and FY18. We see a moderation in the employee cost in energy sector from 26.8% in FY17 to 1.8% in FY18. This chart shows the fastest growing sectors in terms of growth in employee cost. Sectors such as mining, shipbuilding, finance, non-ferrous metals, and electricals have witnessed double-digit growth in FY18. Mining, electrical, and finance sectors have witnessed double-digit growth in employee cost in FY17 as well as in FY18. Moving on to the average cost per employee. We see that growth rate in average cost per employee has moderated in each of the previous 3 years from 5.8% in FY16 to 4.3% in FY18. The table here shows a snapshot of the sector-wise distribution of average cost per employee. We find that labor-intensive sectors like agriculture, textile, and mining are the lowest paid sectors. Services sectors like trading, IT, and aviation are the highest paid sectors, providing an average employee cost of more than 10 lakhs per employee. To conclude, job creation in the corporate sector has lagged GDP growth. We see that the large companies, that is having a net sales of more than 1000 crores, are contributing to job growth. Secondly, there is a higher share of companies with negative or unchanged employment growth in FY 2018 over FY17. Finance and retail sectors have been the leaders in terms of employment growth, followed by construction, banks, and infrastructure. Smaller companies, that is having net sales less than 100 crores, witnessed a contraction in employment growth compared with a positive growth in larger companies. Higher sales growth is not translating into employment growth in 16 out of the 39 sectors. Lastly, growth in salary bills has been fairly constant for the last 3 years and average salary per employee is growing slowly. The growth in salary bills has outpaced average inflation in the previous 4 years. Thank you.
Thanks, Sushant. Dear participants, we'll be taking a break of 2 minutes before we come back to have the Q&A session. Any questions or any, you can please type in the slot provided. I repeat, we'll be having a break of 2 minutes before we come back and begin our Q&A session. Thank you.
Welcome back, everybody. We have received a few questions. There is a question as to what are the current employment trends for FY19. Here we do not see any noteworthy improvement in the employment situation in the current year. In fact, if the CMI employment survey is any indication, there has been a decline in the employment rate compared with March. In March, it was around 40.6%, and as of November, it is 39.9%, which shows that there has in fact been a decline. We have received another question as to which sector is currently seeing favorable employment prospects. Here, in our opinion, it is the construction and infrastructure segment which has favorable prospects here. This is mainly on account of the push from the government in their focus on infrastructure creation and development. Oh, we have another question as to what is the outlook on employment in the IT industry. In case of the IT industry, we feel that there could be a revival in employment here, given the increasing need for having skilled personnel to look after the digitization operations, especially for non-IT companies. Also, given that there has been a considerable number of new startups with niche technologies coming up. They add to new job roles in the market. Mm, Lastly, the rupee depreciation has also helped this segment to an extent in generating revenues, which could, in the course of time, turn to more hirings. We have another question on what is the outlook for the telecom industry. Uh, Telecom industry in recent times has seen a number of job losses, mainly because of the high level of competition there. We feel that the employment situation could improve when the sector stabilizes, which however is some time away. Also, there are prospects for this sector with the deployment of new technology, especially in the areas of artificial intelligence. Okay. There is a question as to why the textile sector is not seeing uh, significant employment generation. This is mainly because the textile sector has lost out to export competitiveness. There has been a shift in exports from Indian markets to other Southeast Asian countries and to Bangladesh. So, given that this is an export-driven industry, uh, the losses here have led to lower employment in the sector. We have one more question as to the employment situation in the mining sector. Uh, this sector is going to continue to see weakness like it has in the past a few years. It is mainly because of the overall weakness in the sector, given their stressed financial position. In addition to that, aspects like safety hazards and the contractual nature of employment has been one factor which has led to lower employment in this sector. There is a question as to will retail see a similar increase in growth given that more people are getting into the middle class? Coming to the retail segment, we have seen that retail has been one of the sectors which has seen a high growth in sales and a high growth in employment growth rates. So this indicates that with a rise in demand here, there has been a commensurate increase in employment in the sector, and going forward also we feel this is likely to continue. If recent industrial output data is also to be factored in, there has been an increase in consumer durables output, which is again indicative of consumption demand. So we are generally positive on the employment prospects for this segment. There is a question here with regard to one of our charts. It says that we have shown in the chart banking and finance as different bars. I just wanted to see clarity on whether they are part of finance. Here, the finance companies include the NBFCs, and the banking is exclusively banks. So they are two different parts, but the overall finance segment. Okay, there's a question on the employee costs having slowed down. The question is as to what exactly this means. Is it because increments have been lower? What we have shown here is that the growth in employee costs have slowed down over the growth in the previous year. This could be because of new hirings at a lower cost. One of the reasons could be of also lower raises in salaries. There's a question on what are the prospects for jobs in the education sector, given that there's considerable push by the government for its improvement. What we have seen is that the job growth rate for this sector has been negative, and it has fallen in FY18. We do not see a significant improvement in the sector for at least this year and the coming year. There is a question as to, other than the data shared in annual reports, is there any other avenue for data that can be used for the study, probably for next year? Uh, there are various other surveys which do come up with their findings, but some of them come up with a significant lag. But we feel that to get a sense of what the employment situation is in the corporate space, the annual reports for whichever companies the data is captured provides a good indication. In addition to it, you have your CMI employment surveys also, which also throw some indications as to what the employment situation is.
I guess there are no more questions coming in, so that would be the last query we had answered for the day. Thank you again for being a part of this webinar. We hope it was insightful. For any feedback or any other clarification suggestions, you can please write to us at the suggestion box, which will be coming no sooner the webinar ends. Thank you and goodbye for now.